Hi, it's Mike here, your host of the Geared for Growth Property Investing podcast. Now, I wanted to put together a little bit of a bonus episode. It's obviously tax time again this year, and I spend pretty much every episode interviewing the best and brightest in the property investment game, anything from economists to accountants to inspectors and buyer's agents. But I wanted to share some of my expertise. I've been in the tax depreciation or quantity surveying business for, well, I guess a decade or maybe even two now, and I will not abide any listener of this show not nailing their tax depreciation deductions. I don't ram what I do down people's throat, but I wanted to provide some real value to you property investors listening out there in this upcoming tax time. So I wanted to share 4 key tips for property investors to make sure they're boosting their tax returns come July. The first thing I want to talk about is repairs and maintenance. Now, the ATO have banged on a couple of years in a row about repairs and maintenance versus, say, depreciable improvements. Now, repairs and maintenance are great deductions for investors because you get to claim 100% of the value of what's been done in the year in which the cost was incurred. So if you're doing some touch-up work to your deck and it costs you $800, then you can claim an $800 instant deduction in that financial year. Now, it's important to note that there's a difference between repairs and maintenance expenses and depreciable assets. So as an example, if you are repairing a hot water system solenoid and replacing that in an existing hot water system, that could be considered as repairs and maintenance. But if you replace your hot water system with a new item, that needs to be depreciated over its effective life, which depends whether it's electric, gas, or solar. But it isn't an immediate deduction, and investors should be really careful to make sure they're not getting that categorization wrong. The second thing I really wanted to share in boosting your tax deductions this financial year, or at the end of this financial year, this is even something that you can do before June 30. That is upgrades and improvements to the property. So repairs and maintenance, sure, we've covered that. That's a great way to get an instant deduction. You can do things on June 30 and claim 100% of the value. But if you are considering more substantial improvements to the property, the best advice I can give you is consider what you're doing, because there are ways in which you can maximize the deductions by selecting different types of assets. So for example, for items that are plant and equipment are not part of a set, so $300 or less, that's an immediate deduction. So putting in, say, a ceiling fan would be an instant deduction because its value is $300 or less. Now, if you're thinking something like floor coverings, they're not all created equal. Tiles in an investment property would depreciate the same way as the building structure, which is 2.5% each financial year for 40 years. Where if you elect to put carpet in your property, that's a 25% deduction. So you get 25% of the cost of the carpet each financial, or in the first financial year, I should say. So that's 10 times the deductions by putting carpet in instead of tiles. Now, there might be a good reason why you want to have tiles in your property, but if you are just up in the air and don't really mind what you're putting in there, the tax deductions are pretty significant for plant and equipment items as opposed to things that are classified as part of the building. Next bit of advice I wanted to share was just to get in touch with your property manager. If they're looking after the improvements and the repairs and maintenance expenses on your investment property, then they're probably going to have a fairly good ledger of those expenses. And you want to go through those and make sure that your accountant is claiming those correctly. So for example, make sure that the repairs and maintenance are correct and those are instant deductions, and that the newly replaced assets, so the ones that you are swapping out like for like, are depreciated over their effective life. Now, as a client of MCG Quantity Surveyors, if you're adding 1 or 2 items, we can update your tax depreciation schedule free of charge. The last thing, and this is, I mean, honestly, this is my podcast and I'm about to flog a service, but let me put it this way. My last tip is to get a depreciation schedule if there's value in it. Now, I actually don't really care whether you use me or somebody else. If you've got deductions available in your property, you ought to be claiming them. Of course, I'd love to help you, but it's more important to me that you get what entitlements are out there for you, because when you are a property investor, you're performing a pretty key service. The government is out of the public housing business, and by renting your property, you are providing housing to someone, and the government gives you tax deductions based on the fair decline in value of your investment as it wears out over time. So to give you some numbers around tax depreciation deductions and people that miss out on those deductions, we did a study of 1,000 residential property investors that came through our doors. What we found was that 6.7% of them actually waited so long to engage us to prepare a depreciation schedule that they missed out on deductions. Now, you might know that you can actually back claim 2 financial years worth of depreciation deductions. So we're talking people that waited more than those 2 years. So the average was around 3.6 years in contacting us. In one terrible example, we had a lady buy a unit off the plan 16 years prior to contacting us, and the deductions that she missed out on were very, very significant. That sort of stuff keeps me up nights. Now, we had a great back claim for her, but it could have been much, much more. Now, the average deductions that property investors miss in that 6.7% is $20,537. So that could really comfortably be $6,000 or $7,000, maybe $8,000 back in your pocket, depending on your taxable income. Now, that 6.7% might not sound like a really big number, but you've got to remember that that is 6.7% of investors who eventually realized that there was value in a depreciation schedule. So it's likely that there are investors out there, more than 6.7%, that simply just aren't aware of those entitlements being there for them. Now, this might blow your mind, and it's certainly something that journalists like to run with, is these huge statistics. But if you take our figures of an average loss of $20,537, apply that to 6.7% of the total property investor population, that equates to $2.88 billion worth of tax depreciation deductions just sitting out there in the ether unclaimed. So that's my final tip, is to contact a quantity surveyor, get a free depreciation estimate on what the potential deductions are, and a good quantity surveyor is not going to encourage you to go ahead with the depreciation schedule if there's no clear benefit. One of the first questions that we ask is everything that we need to know about the property to assess the potential claims. If it's not worthwhile, we'll say so. We don't want to go ahead with a product that's not going to put more money back in your pocket than what it costs. So to recap, those 4 tips for tax time 2021, well, I guess it's 2021, isn't it? Repairs and maintenance, make sure you know the difference between those and improvements. If you're doing upgrades, consider what you're actually upgrading to the property. Reach out to your property manager, make sure that those expenses are claimed appropriately, and get a depreciation schedule, or at least get a depreciation estimate to see whether a schedule is going to be right for you. Now, if you would like a free estimate of your depreciation deductions or your potential claim, feel free to reach out at mcgqs.com.au. Or if you're a listener to the show, thank you for listening to this little part about tax depreciation. I know tax nerds like me get overly excited at tax time, but I'd love to be of service, and I'd love to hear from you as well, what you're getting out of the show, anything you would like to hear coming up. We've got a few exciting initiatives we're about to release on the show soon. So shoot me an email, mike@mcgqs.com.au. Thanks for listening. I hope tax time is a productive one for you and you get some great dollars back in your pocket this year. Cheers.